Yeah, my name is. Nice to meet you. I'm a PhD student in Monash University from Australia. It's nice.
Oh, very cool.
Yeah, thank you.
Very nice. Good to meet you.
Yes.
What year are you?
Sorry?
What year are you?
I'm in the first year of PhD. Yeah.
Okay, very good. Welcome.
Yeah.
Welcome to the profession a little bit.
Yeah, it's very nice to see you here because I know Toàn has invited you to be there. It's very nice to see you in the room. Yeah.
Absolutely, my pleasure. Always fun to talk about some of this work. So.
So Scott, just curious, how did you get to have that connection with the, university in Ho Chi Minh City?
Ton just emailed me and asked me if I'd be interested in giving this talk.
So it's just cold emailing you?
Yeah.
Oh, actually, I talked with Scott 2 years ago when I did Trump paper.
That's right.
When it was in Germany.
That's right. So I had already, yeah, that's right. Okay.
Yeah.
Yeah. So we hadn't talked in a long time. So it's good. Yeah.
That's true.
So Ton, are you a faculty as well?
Yeah, I'm faculty in University of Economics, Ho Chi Minh City, and before that, I studied PhD in Germany. So I did some research regarding to Trump tweeters, and also I felt that like Scott also have like tweet pace uncertainty, right? Yeah.
Oh, okay.
So we will also talk regarding to how uncertainty can be raised from Twitter.
Idea. Using social media for data sources. But one thing I realized about research I think in the US, but I guess in a lot of places in the world, is that we're trying for new data sources, right? It's all about new data sources. Like, for example, in the Scott et al. Paper about economic policy uncertainty, you guys are using newspaper, which is very creative. And then people are using Twitter and social media. So.
Yeah, no, I mean, in my my kind of other strand of research about using consumption data, yeah, I was very kind of lucky to get in at the beginning of a wave of research using transaction level consumption data, kind of to much better understand household decision making and things like that. So yeah, I mean, it's really incredible the amount of new data. Both I'll talk today about textual data, but kind of other sorts of financial data and stuff like that as well. It's really a good time to be an empiricist. It's a good time to be a theorist too. You can actually test a lot of more detailed models now. But
yeah, I mean, different aspects of the same coin, different sides of the same coin, right?
Exactly.
So.
Yeah.
All right. So I think now we have a very good time that we have some participants now. So I think time to start, right? So first, okay. So let me say something to introduce the very, very, very famous name regarding to the index, economic policy uncertainties. So on behalf of University of Economics, Ho Chi Minh City, I would like to say thanks to Scott to agree to give the talk today in the seminar talk in May 2021. Then, as you may know, Scott is an associate professor of finance at the Kellogg School of Management, and he's constructed the economics policy uncertainty, which has like most cited paper, I think. Then it's a like very, how can I say, like very useful index for many research around the world. Then today we are very happy to have like his present here to deliver the talk uncertainty indexes and stock market trends. The talk will last in 1 hour. Then any participant, if you have any question, you also interrupt. You also chat in the box chat, and you can also keep your question until the end of his talk and ask him. So don't let you wait more. So now the stage is yours, Scott. Thanks.
All right. Ton, yeah, thanks so much for having me out. You know, I'm going to talk a little bit about kind of a few different papers, kind of around the theme of analyzing text and kind of in a variety of ways. And so the first kind of portion is going to be about uncertainty and constructing uncertainty indexes from various sources. You know, Nguyen was talking about, you know, Twitter, using Twitter or using newspapers as a lot of ours do. And then I'm going to talk a little bit more about a kind of a second paper that's taking a very different approach to trying to use newspaper text to analyze kind of what drives stock market jumps. Most of the work is joint with Nick Bloom and Steve Davis, and also Marco Salmon is a co-author on a number of the components. Okay. All right. So, and like Ton said, please, you know, jump in with any questions, or I have the chat window open. If you ask any questions there, I can respond as well. So the first thing I want to talk about is, you know, a paper that maybe, you know, some of you have seen. So this paper with Nick and Steve from 2016 that was about measuring economic policy uncertainty. And I think, you know, our timing was very lucky that we kind of started writing this paper in the kind of early 2010s when, you know, there was a lot of discussion. I mean, this is partly what prompted this paper. Is there a lot of discussion about policy uncertainty, but it came at a time also when there was kind of an increasing access to newspaper, to kind of textual data available from online archives. And we actually had a large number of different metrics to try to measure policy uncertainty. And the newspaper kind of based component was just one of them. But it's kind of been the most enduring and the most flexible. And so that's where we've expended a lot of effort to kind of expand to more countries and different time periods, leveraging the strength and flexibility of newspaper data. So what did we do? I mean, the approach was really simple. I mean, this was, you know, just like 10 years ago or so, we started this paper, and yet, you know, the kind of literature has moved a lot since then, and people are making much more nuanced and complex sorts of series. We just basically took 10 large U.S. newspapers. We, you know, wrote a script to count the number of articles every month that contained a triplet of terms. So terms about the economy, terms about policy-related terms, and then terms about uncertainty. We took the ratio relative to the total number of articles, and you know, we kind of normalized across papers to get a composite U.S. monthly policy uncertainty index. And, you know, it looks something like this. So we update it every month still on our website. You know, feel free to download the data. You know, recently we thought that there was you know, some spikes in the kind of, we started writing the paper around here. You know, there are lots of spikes, and then, you know, the kind of COVID crisis has really blown every other kind of period out of the water in terms of being extremely high levels of policy uncertainty as the government started, you know, passing largest stimulus packages, you know, ever passed in history, shutting down private businesses, abrogating contracts, you know, lots of things like that. So the government kind of took unprecedented levels of powers, and you know, generated tremendous amounts of uncertainty in just the past year or so. Okay. So just a little bit about, you know, the approach in general. I mean, on our website, we have data not just from the US, but for about 25 different countries regarding mostly around policy uncertainty, but also around a number of related concepts as well. One really nice thing is that we can have kind of categorical indexes. So we can, you know, not just look at overall policy uncertainty, but we can also look at various types of policy uncertainty or details about other specific topics. For a number of countries where we have good newspaper data going far back in time, and kind of the quality of newspaper archives is improving, you know, every year is getting better, and lots more countries are putting on and digitizing old newspapers. You know, newspapers have been around for hundreds of years, and it's just a matter of time before, you know, we get all that data online, basically. We've developed some other uncertainty measures for different settings like financial markets. And we also even have some things online that are like firm specific. So there's some nice papers using like earnings reports. We're working on some new data from financial news wires that get down to a firm or industry level. And so you can get, not just country like US level policy uncertainty data, but going to the state level or going to the firm level or the industry level, and maybe at a daily or weekly or monthly level. Okay. So lots of data available. Most of it revolves around newspapers. And like I said, one really nice thing is we can go across countries. It's often difficult to get lots of financial information for some countries, especially going back in time before financial markets were necessarily well developed. But thankfully, a lot of newspapers existed for many decades or even hundreds of years. So this is a composite index looking at European policy uncertainty index across 10 papers from the five major European economies. And you see a lot of similar spikes. So, we see kind of the Russian financial crisis, LTCM, we see 9/11, but we also see some things that are kind of unique to every different country. So in Europe, there were a lot of things that revolved around the Nice Treaty and around the EU, creation of the EU, or when new countries joined the EU. There's a lot of uncertainty around some of the European debt crisis events and also local European elections. And certainly Brexit had a huge place here as well. Sorry, this isn't updated towards to the COVID period, but COVID similarly in Europe was tremendously huge shock as well. Similarly, we have some in Asian economies as well. So this is looking at India. And, like I said, you can go to lots of different countries with newspaper archives. We have some caveats, like we can't get good economic data or good newspaper data from North Korea, or we don't believe their newspaper data maybe. And so, this might limit the approach. But for most countries, we can generally get at least a few high quality financial newspapers to build these sorts of indexes from. All right. So why did we go with newspapers? Like I said, when we started this project, a number of years ago, we had lots of different metrics that we were trying to use to kind of benchmark policy uncertainty. But newspapers seem to be, the most flexible and the most powerful in a lot of different ways. So one nice thing is like I just showed you, this methodology can be replicated across lots of different countries and in lots of different languages. So there's lots of data sources where you get, a good measure for one country, but then you're kind of back at square one for another country. Here, if you develop a good set of terms and kind of a good methodology and a good code base, you can really roll this out across lots of countries with not too much effort. The other nice thing is that we can extend this often very far back in time. So, before there was good options data, or before there was good financial market data, or before there was good, macro, like NEPA data for the US industrial production data or national accounts data, you can go and there were newspapers being published. And so as those are digitized, you can push these indexes back in time a long ways, and you can use that to proxy for a lot of other things we might not have good measures for. The other nice thing, which maybe some of you have noticed, is that we continually update this data, and we can kind of keep it up to date with not too much effort. So it's mostly automated, and so we can put out daily and monthly indexes. It can go very high frequency, all the way to the daily level, or for some researchers are actually trying to push to an intraday level, looking at wire reports, and rather than an annual level or a quarterly level that a lot of other economic data series occur at. It's very, very flexible in terms of content, right? So text, it's a really rich medium. Newspapers have a lot of information embedded in them, and kind of new methods of natural language processing are continually coming out that are really helping economists to kind of evolve from our very simple approach, which we think still has some benefits, but building out all sorts of different sentiment measures and closeness and being able to non-parametrically separate into do different sorts of topic modeling and things like that, and get many more dimensions of information all from these text sources. And then the last thing is that, access is pretty easy, low cost, pretty democratic. A lot of people can do it. PhD students can do it. If you have access, some newspapers, like maybe some newspapers in Vietnam, put up their archives online, just publicly, or maybe you just have to subscribe to the newspaper to get access to it. And so often it's very cheap for researchers to get access to, rather than having to pay thousands or hundreds of thousands of dollars to some financial software subscription. It's pretty easy to use. All right. And so, like I said, one of the things that we do is that we try to break down and go beyond looking at aggregate policy uncertainty, but we can use this to really look inside policy uncertainty and decompose into its kind of constituent pieces, right? So policy uncertainty might be similarly high at 2 different points in time, but at one point in time, maybe it's because of lots of healthcare uncertainty. At another time, it's because of very high military policy uncertainty. And you can see here we're looking at the same sort of newspaper approach, but using an additional 4th set of terms, which is kind of a topic-related terms related to health policy topics or defense policy topics. And you can see that they look very different, right? So defense policy uncertainty spikes around 9/11 and various military interventions in the Middle East by the US, whereas healthcare policy uncertainty spikes around the discussions of Obamacare or a kind of previous attempt to kind of have a national healthcare system under Bill Clinton and Hillary Clinton. And you can see how these evolve a bit differently over time as well. So this is looking at a suite or several different kind of topic, categorical policy uncertainty topics. And we can see that, around, say, the 2016 election of Donald Trump, there was a lot of uncertainty about, US fiscal policy. And that kind of declined a bit over time. Where we see a huge spike in trade policy uncertainty to kind of unprecedented levels in recent history, when the US started engaging in lots of tariffs and various discussions with China. And then when COVID occurred, all that trade policy uncertainty essentially disappeared. And we have this huge spikes in healthcare policy and fiscal policy, again, as the government starts talking about passing stimulus programs and unemployment insurance and the PPP program of kind of business subsidies and things like that. And the Fed steps in to slash rates. And so you get a spike in monetary policy as well. And so I think, we're trying to give basically more degrees of freedom to researchers to really understand what's driving policy uncertainty. And this kind of has different predictions for different sorts of firms or for, different downstream economic phenomenon. And again, we do this for the US. Some other researchers that have posted data on our website have done it for a couple other countries. But it's certainly something that, wherever you can basically make an overall aggregate policy uncertainty metric, you can break it down into categories as well. All right. We did this infectious disease tracker that was looking at a newspaper-based metric of the fraction of discussions of equity market or financial market volatility that also discussed infectious diseases. And we've rolled this back in time. And again, you can see that this is part of kind of another paper that Nick and Steve and I were working on. And you can see that, you can see some of these spikes around previous disease outbreaks, but they are just absolutely dwarfed by the coronavirus, response. And so again, this provides, something that you probably already knew, that coronavirus was a big deal and, lots of news, but this is kind of one way to quantify it and put it in more of a historical context as well. All right. So one of the things that came up in our paper and when we were presenting this is, can we actually trust this data, right? We don't have another measure of policy uncertainty really. And so, how can we be sure that we're actually picking up uncertainty about economic policy? So one thing that we wanted to do is move this approach, move this methodology of newspaper search to an arena where we do have an existing measure. And so we've replicated the methodology in the realm of financial markets. And so we have an existing measure of financial market volatility or uncertainty in the form of the VIX. And we can basically replicate our newspaper-based approach by searching for, instead of economic policy uncertainty, we search for equity market volatility terms, but the kind of the same idea and same sort of normalizations. And it actually matches really, really well with the VIX. So essentially every time the VIX sees a spike, this EMV index sees a spike as well. So this gives us a little bit more confidence that when you turn the methodology to trying to measure policy uncertainty, we're also kind of picking up something real. Another thing that came up is, are we getting biased results because the newspapers are kind of leaning left or leaning right or have different political inclinations? And we did some tests there as well, and it didn't seem to be a first order issue, at least in the US. Most of these papers kind of on the left and the right were spiking at similar times. Now, potentially in other places, other countries, other contexts, you might see bigger differences across newspapers, but at least for our main index, we didn't think that this was a primary concern. In other places, if there's official government newspapers, right, that might give maybe a different impression versus a privately owned newspaper. All right. The last thing that we did was a bit more involved, and basically we had a number of undergraduates and myself and Nick and Steve read thousands of these articles ourselves over a couple-year period, and basically go and actually code them and say, is this article that was flagged as talking about policy uncertainty actually talking about policy uncertainty? And at the end of the day, we find that the newspaper-based approach, the kind of text-based, just keyword-based approach, does a pretty good job at matching the human codings as well. And so we think that while our approach was pretty simple and pretty straightforward, it does a pretty good job of picking up the sorts of articles we're looking to pick up. And so we think that that's kind of a nice feature, is that, even with this simple approach that's kind of easy to replicate, easy to roll out across different countries, and importantly to us, we think it's kind of easy to understand, it still can do a pretty good job of capturing what we want to capture. All right. Okay. So that was one kind of newspaper-based approach. There's been lots of kind of activity in this space, looking at trying to do different measures of uncertainty or kind of sentiment-related topics, or just topical discussion that are based on automated approaches. We've kind of gone down this route a little more ourselves. And we have this index. We have a kind of a Twitter-based index now, which again takes a very similar sort of approach, looking at tweets that talk about economic uncertainty, and it tends to track fairly well with a lot of the policy uncertainty metrics that we've had. One nice thing about using Twitter is that you can really get down into kind of an individual level. So we're trying to expand this a little bit and see what sorts of people are doing a lot of the tweeting. Is it journalists? Is it political figures? Is it private individuals? Is it businesses? And then you can track some of their sentiment kind of over time. So going from basically a cross section to going to a panel dimension will allow for some additional sorts of analyses. The downside, of course, with Twitter is that Twitter hasn't been around forever, and so you don't have the same sort of time span that you do for newspaper approaches. Another approach is using these the Economist intelligence unit reports. And here, this is kind of these reports that are put out by the economists that are fairly in-depth discussions of basically every country or most countries in the world. They're about 30 pages long. They come out quarterly and they kind of update the reporting every quarter. And so they get down to discussing topics about various sources of uncertainty about different countries and their economies, and a lot of the political aspects as well. And the nice thing with the Economist Intelligence Unit is that there we can take the same approach as we did for newspapers, but you can roll it out across 143 countries very costlessly, right? All of these reports are done in English. They're all in kind of a very standardized way, so you don't have to be too worried about big biases in reporting or biases in coverage. They're about the same length, and so here you get a more of an equal weighting across countries. Again, this doesn't go back quite as far as some of the newspaper archives, but it does go back to the 1990s. And so here, we can get across 143 countries instead of just, 25 with our newspaper-based approaches. And you're seeing, a kind of a strong increase in policy uncertainty in general, around the financial crisis, in particular in the Greek debt crisis. This is back in around 9/11 and the Iraq War, and then, unprecedented surges in the last year or so with coronavirus. Okay. So policy uncertainty is certainly becoming, a big kind of a big driver. Governments are getting fairly interventionist. Governments are generally growing in size, and their scope of activities that are driving the economy is kind of increasing in general. The other nice thing about the intelligence unit, the Economist intelligence unit approach, is that we have a much broader span of countries. So most of the countries that we're looking at with the newspaper-based approaches are kind of relatively higher income. Here you get a much broader spectrum, and there are actually some interesting variation in kind of uncertainty across countries. Of different kind of levels of development. So advanced economies, they typically have somewhat lower levels of uncertainty or economic uncertainty in general, and kind of you have the highest mean, but also the highest spread among kind of the lower income economies. And so some of this is that, these economies are in general are more volatile. Their governments might be a bit more volatile. And kind of taking a wider range of potential action. Sometimes you also have bigger swings in kind of who's in control in some of these places as well. Though certainly, the West has had some pretty drastic changes in control over the last several years. All right. Any questions so far? Looking good. All right. So, there's a lot of different ways where we can try to measure policy uncertainty or kind of economic uncertainty in general. A whole suite of new approaches. A lot of my own work is using, coding in Perl and Python, and it's really simple to use. People are using a lot more nuanced natural language processing tools to build out lots of different sorts of topic models and kind of. They're a bit more black boxy, but they also have the promise of maybe being a bit lower cost to roll out, and they might also give some additional dimensions of measurement to researchers as well. We wanted to take this in that 2016 paper. We wanted to kind of have at least an application and say, what are the impacts of policy uncertainty, that we're not just measuring it for the sake of measuring it, but we think that policy uncertainty actually does have some important implications for the economic development and for firm level behavior as well. And so in terms of theory, you might expect uncertainty and political uncertainty in general to drive decision making at a household level or a firm level through a number of different channels. So, one is just this cost of capital channel. So, a lot of this theory has been very long standing, and we're just kind of contributing some, empirical measurement to it. But, all the way back in 1958, Tobin talks about how, increases in risk, increases in uncertainty and volatility can raise borrowing costs for firms or actually for households as well. And this might have the effect of cutting investment, cutting spending, increasing the cost of investment for firms. You also have a real option effect, and this is what a lot of the literature recently has focused on. Often citing this Bernanke, 83 paper, and basically saying that increases in uncertainty, they cut demand by making firms and consumers both much more cautious. And so, when mistakes are more costly or when the decision-making environment is less clear, firms are basically going to try to wait out the uncertainty. They're going to cut investment now. It might lead to some overshooting investment later, but overall, it's going to be basically a decline in investments, in hiring, in reallocation of capital and labor. And so you get these, basically you move out the zones of inaction for these things as you're kind of increasing transaction costs and increasing the possibility of incurring big losses if you make investments now. And then the last thing that's a bit more of a recent literature is talking about, you know, liquidity constraints and financial constraints. Some of this relates to precautionary savings as well, but basically the uncertainty can increase the demand to kind of hoard cash by firms. Right. So what we wanted to do in particular in the 2016 paper is to say that, you know, not only is economic uncertainty important, but we think that policy uncertainty is of particular interest and had been increasing over the past several years relative to kind of historical normal levels. And, you know, we've certainly seen that kind of continue to rise in recent years. And so what we wanted to do is to look at whether policy uncertainty has differential impacts for kind of firms that are more driven, whose revenue is more driven by government contracting, right? So in general, the concern around a lot of these sorts of regressions is that when uncertainty is high, it's also a period of like a recession or of you know, kind of a downturn in the business cycle. And so you have these very correlated or negatively correlated first and second moment shocks. And so what we wanted to do is look at the heterogeneous effect across firms. And so we could exactly control for these time varying effects that are affecting the whole economy, and look at for differential effects of policy uncertainty on firms that are kind of more exposed to policy uncertainty in particular. And so what we did is we looked at the Federal Registry of Contracts. So every contract that the U.S. government makes is public, and at least for the past 20 years or so. And we match these contracts to CompuStat firms, and we basically look at firms according to how federal contract intensive they are. We also do take a similar approach in terms of regulatory intensity, which is basically how exposed firms are to regulation, and we're going to get similar results. But here you can see the types of firms most exposed to government behavior. A lot of it is military, so guided missiles. 80% of their contracts are coming from the U.S. government. You also get lots of heavy equipment, construction equipment, doing infrastructure building. You get, so infrastructure types of stuff. This is kind of more military. You also get a lot of healthcare systems and other sorts of accounting sorts of firms as well. Okay. All right. And so once we do that, this basically gives us a dimension to sort on and to have some interaction terms for. And so what we're going to do is we're going to look at various sorts of outcome measures at a firm year or firm quarter level. We're going to include firm fixed effects. We're also going to include period fixed effects. And so this is going to control for any sort of economic downturn that we're seeing that might be contemporaneous with an increase in policy uncertainty. And then we're going to interact our government exposure measures, either that contract intensity or regulatory intensity measures, with our measures of policy uncertainty and with government expenditures. So this is kind of a first moment shock to these sorts of firms, which is just government expenditures, government spending on goods and services. And this is going to be our second moment measure of policy uncertainty. Okay. And so hopefully we're going to be able to disentangle from general business cycle effects, the differential effect of government contracting and of government-based uncertainty. And so one thing that we see is, we're going to be focusing on these interaction effects, is that the firm-specific volatility, and both realized volatility and implied volatility of their asset price, of their stock prices, is going to be higher in periods with high levels of policy uncertainty. And so here we're looking at log DPU times these federal government intensity measures. And we basically see in lots of different types of specifications that you see a strong impact of policy uncertainty, especially on these sorts of firms. Okay. And one nice thing is that going to our categorical measures, you can actually see that most of this effect is not just coming through general policy uncertainty, but is actually coming through policy uncertainty directly linked to that category of firm. So for defense firms, they see much higher volatility and implied volatility when defense policy uncertainty is high. Similarly for healthcare firms and financial firms as well. Okay. And you can see here that this kind of overall economic policy uncertainty metric then declines into insignificance, and all the power is coming from these categorical specific measures. Then thinking kind of those are financial effects, then we can move to looking at real effects as well. And so we have two main sorts of real effects. The first is going to be investment. So this is investment scaled by lagged assets or lagged fixed capital. This is going to be for these four columns. And then for these, we're seeing changes in employment. Okay. And then the last, we're basically taking revenue. Okay. So we're seeing if there's any direct effects of policy uncertainty on revenue above and beyond the government contracting. And so for the first four, we see big negative effects on investment of policy uncertainty. We also see big negative effects on hiring. And none of this seems to be driven by big changes in revenue. So this is kind of an insignificant effect. So the policy uncertainty seems to be affecting firms' decision-making without necessarily affecting their revenue in the current year. Okay, it might affect their expectations of future revenue or near-term revenue, but is not in response to any near-term shocks. All right. Okay. So that's basically all I wanted to talk about in terms of these kind of automated approaches. We're very happy to talk to people who are developing other measures. We've listed, we've hosted a lot of different measures that are updated by other researchers on our website. So if you have some, want to build an index for Vietnam or for another Southeast Asian country or somewhere else, we're certainly always looking to expand the kind of country level coverage of on our site or kind of in general that other researchers can then go and use. And so more broadly, I think there's lots of really interesting work going on with the automated sorts of kind of textual analysis with the huge amounts of textual data that are being put online. And some of this is, firm level data, newspaper data, Twitter data, social media data, data from forums, data from, regulatory disclosures or mandated disclosures from firms that are publicly listed. There's lots of cool data out there that, there's lots of off-the-shelf tools. I think economists are generally not going to be really at the frontier of textual analysis. Probably we can leave that to the computer scientists maybe. But hopefully we can, once they integrate those tools into nice packages in Python and stuff like that, we can go and use them and generate lots of cool new metrics for measurement. For the rest of the talk, I wanted to spend talking about a newer paper that Nick and Steve and Marco Salmon, who was a grad student at Kellogg and will be joining HBS next year. We've been working on this project for a few years now, and this is kind of at the opposite end of textual analysis. So instead of taking a machine-based approach, we take a very manual human-based approach, which we think has some benefits and as well, but is much more time-consuming and much more costly. But we'll post a bunch of the data online, so hopefully other people find some nice uses for it as well. And this idea or this paper is trying to understand what triggers stock market jumps. And again, instead of using a very automated approach, we use a very human-based approach that I want to describe a little bit. And so what we're going to do, it's a very simple idea, just kind of manpower intensive. So basically, we're going to look at every large stock market movement in the US and actually as of now in about a dozen other countries as well. And so for the US, this means every day where there's a bigger than 2.5% move in the overall stock market. This picks up about 3.5% of trading days in the US since 1900. Okay. We're going to look then at a relevant newspaper article from the next day. So we're going to look across a number of big newspapers in the US. For other countries, we're often just looking at one or two newspapers. And almost always after a jump of this magnitude, there's going to be a newspaper article in a major newspaper discussing it. We're going to have multiple coders read each article, and then we're going to have them record a number of things about that article that are discussing that large stock market movement. Okay. So first of all, we're going to have them write down the category, the driver, the cause of that jump, and I'll tell you about the categories that we ask them to bucket things in. We're going to ask them to evaluate the confidence of the journalist regarding the cause of the jump. We're going to ask them to say how easy it was to categorize that jump into one of the 16 categories that we have. We're also going to ask them to say where that jump originated from. So there might have been a large market movement in the UK, but maybe the stock market in the United Kingdom jumps because the Federal Reserve in the US, had some announcement. Okay, so a lot of times it's domestic cause, but often it's international as well. So why are we focusing just on these large jumps? Well, we think that these are meaningful. So in the US, we get about 10 jumps a year, but this accounts for about half of total squared returns or total daily volatility. So these jumps in and of themselves, it's kind of a manageable number where we can go across a very long time span into lots of different countries, since it is a very manual approach. But we can get a lot of days that are really impactful. So it's about half of total daily volatility, about a quarter of aggregate daily returns. It's partly practical. It's a manageable number, but also the newspapers don't always discuss days that are very calm in the market. And they pretty much always discuss days that are very volatile or have big market movements. And then also this allows us to be very broad. So we're going to look over 5,000 different stock market jumps across 15 countries. And we're going to be able to, categorize them and characterize them in several different ways. The other thing, in contrast to the first half of this talk, which was all about, just using keywords and textual and automated textual analysis, we're turning to humans. And we think that actually there's a lot of kind of nuance in some of these articles that humans are better able to capture. And so if you take a bag of words approach, kind of the thought experiment we like to have is, if you jumbled up two of these articles and just put all the words, in random order, which is basically what a lot of kind of computerized NLP approaches do, it's actually very difficult to kind of try to figure out what they're talking about in a lot of these articles. So there'll be a lot of different topics in financial market, things that happened in the financial markets discussed. But if you put it in order and have a human read it, it's sometimes a lot easier to understand, what are they actually asserting drove a large market movement. Some of this requires some economic knowledge. Was this a actual surprise move by the Fed, or was the Fed just responding to macro news, right? So in one case, we would say this is driven by a monetary policy innovation. On the other side, it would be news about the macroeconomy. There's also a lot of variation over time, especially over the time horizon that we're looking at, where words kind of change in meaning. So there might be a war being discussed, and that could be World War II, or that could be a trade war in more recent years. And then there's also some kind of context that can be missed. So newspapers will often say something like, the president spoke last night, and that's why markets moved today. But the kind of market participants knew what that speech was about. Was it about a decision to go to war? Was it about a new stimulus policy? Was it about a regulatory change? Was it about an election? And those are very different things that kind of the market understands at the time, but a computer would be very hard pressed to kind of understand within the context of the article itself. All right. So we're going to ask these coders to go and read these articles and encode them up into various categories. And so we're going to have a number of categories, both policy related, kind of linked to our interest in policy uncertainty in general, and also related to non-policy categories. And so you can have everything from fiscal and monetary policy. You can have macro news. This could be news about unemployment numbers, or about GDP numbers or inflation numbers. You can have corporate earnings. So there might be a big bankruptcy, or if Apple or Amazon reports really good earnings, maybe that will move the whole market by quite a bit. news about commodities and commodity prices, or kind of other sorts of other categories as well. All right, so we're going to ask them to put them into one of these categories, just as an example of one article that's pretty clear. So if we have in 2008, this is during the financial crisis. This is actually the day that the U.S. House of Representatives rejected the kind of bailout package that was being proposed, the $700 billion. This is kind of the big rescue package for the kind of banking system. And the House rejected it. They thought it was kind of too expensive, and markets dropped by almost 9% that day, okay, in the U.S. And so this was a very clear article. We would say that this market movement was driven by news about government spending policy, which is a policy category. The geographic source of this news was the U.S., and we would say it's very clear and it's easy to code. Okay, just as one example. We take a lot of, do a number of different tests to try to gauge how reliable having undergraduates and grad students code these articles are. So one nice thing is that we have multiple coders code the same days and the same papers and the same days across different papers as well. And the nice thing to see is that human coders tend to code these days very similarly, especially when they're using the same newspaper. And especially in the case of high quality financial focused newspapers like the Wall Street Journal, the agreement rates across coders coding the same day is very, very high. There are more differences coding the same day across newspapers. Some of this tends to be driven by the fact that some days are somewhat unclear in terms of what drives a particular large market movement. And sometimes journalists working at different newspapers might disagree about the cause and write down different things in their articles. The other kind of validation that we do is that we look across a number of different calendars for events, for days where we know certain events happened. So for instance, we can look up a calendar of all of the Federal Open Market Committee, the Fed announcement dates. We can look at the dates where there's new jobs numbers coming out in the US, or there's inflation data coming out. And we can look around national election dates in the US. Okay, all of these are kind of fixed and we can easily import them. And basically on financial market jumps that occur on those days, our coders are much more likely to code those in kind of a relevant category. All right, again, they're not looking at these categories, they're just reading these newspaper articles, but they kind of correspond well with what we think was probably driving the markets on those days. Okay. All right. So some key findings from this paper. One is that policy kind of drives jumps and drives the financial market in very different ways than non-policy related news. So government policy tends to drive a much higher portion of positive jumps relative to negative financial market jumps. It's very counter-cyclical, and it's become much more counter-cyclical over time in the US. It's also a lot clearer. So articles that or days that are discussing kind of government policy-driven jumps tend to be much more clearly written and more clearly attribute the financial market movement to a particular government policy. The other thing that we see is that volatility it kind of responds differently to some different types of jumps. The biggest outlier here is monetary policy. So volatility tends to be much lower after jumps that are triggered by monetary policy, and relatively higher after jumps triggered by non-policy categories, especially macro news. We also find that clarity matters quite a bit. It's similarly in driving follow-on volatility. So volatility is higher after jumps that have unclear origins. And we also see that at least in the US and also in the UK, where we have kind of good historical data as well, clarity's increased a lot over the past 120 years. Some of this we think is driven by better financial news and sophistication by journalists. Some of it is better data and better data releases and better communication on the parts of journalists. And the last thing that was kind of interesting is that the US tends to dominate globally. So we asked our coders, if you recall, to kind of write down for each article and each financial market movement where the news occurred that drove that market movement. Outside the US and outside Europe, the countries that we cover attribute almost a third or around a third of jumps to the US, okay? The share attributed to Europe is under 5%, even though Europe has an economy in aggregate about the same size as the US, or if not a little bit bigger. Okay. One other thing that we see is that the prevalence of these categories changes a lot over time. And kind of one nice recent example was that during the recent trade wars between the US and China in 2017 to 2019, there were 5 of the 13 large financial jumps in the US were driven entirely by trade policy. Okay, and so these are newspaper articles from those 5 days. They're all very clear. Trump tweeted something, or China said something, or some new agreement was reached, and financial markets, fell by 3% or increased by 5% or whatever else. If we look back in time, so in the post-war period from 1945 to 2016, so up until this trade war kicked off, there were 782 large market movements in the US. 0 of them were solely attributed to trade policy, okay? And actually, you have to go back to 1932 before FDR's election, where there was a market movement that was solely attributed to, to trade policy. This was when when FDR was discussing his belief in tariffs during the Great Depression, okay, right before the election. And so you do see a lot of these big changes over time in kind of what sorts of news is driving financial markets. Here we have just a categorical breakdown. So for US equities from 1900 to kind of the whole sample period, this is just the post-World War II period. And then we also do a similar exercise for US bonds and exchange rates as well. And so we can see that, here we go. Macro news is the biggest driver of large market movements, maybe as we might expect. So news about kind of the fundamental performance of the overall economy or various major aspects of it. Obviously, big drivers of changes in asset prices, and it seems to have become more of a driver in the second half of the sample in the U.S. Monetary policy has also increased in kind of importance in the second half of the 20th century as the Fed kind of became a bit more activist and involved in driving the economy. We also see falls, right? So macro news and monetary policy increased in importance. We also see declines in driving in things like commodity prices, driving big financial market moves, and government regulation, which becomes less of a driving force. If you look to other asset classes like bonds or like exchange rates, you see almost 100% of the large movements in those asset classes being driven by 2 things, by macro news and by monetary policy. And so they are much more concentrated in what drives kind of large movements in those sorts of asset prices than is true for equity prices. And this is something that we've confirmed in the UK and in a couple other countries as well. All right. Just going through a couple of the other results. Like I mentioned, the policy news and policy jumps have become much more counter-cyclical over time, and they're much more positive in general. So here we're looking at along the x-axis. This is just a bin scatter. So we're looking at the x-axis is the size of the market movement that day. So you can see there's kind of a hole in the middle where we're only looking at days moves larger than 2.5%. Similarly here, and you can see that kind of pre-1980 there was a positive relationship where the more positive the day's market movement was, the more likely it was to be attributed to government policy. Okay, but the slope of this relationship became much steeper. It tripled in the post-1980 period, and now if you see a really large stock market movement, it's kind of more than likely, more often than not, this is like 2/3 of the time likely to be a policy move. And if it's a very large negative movement, it's very unlikely to have driven by government policy. So some of this is you know, the government in general has become more countercyclical and has become more sensitive to recent trends in asset prices. And so when the stock market is crashing, the government nowadays is much more likely to pass some stimulative policy and try to, you know, or some sort of countercyclical policy. The Fed is more likely to take action if, you know, markets are overheating. But in general, the government is kind of stepping in where there's negative equity returns, causing big positive responses. And this is something that's not just true in the US, but seems to be true in every country that we look at. So actually, policy news is more likely to be positive than negative in every single one of the other countries that we've looked at. Some of them it's kind of a bit closer than for the US, but in general, it's kind of positive and often strongly positive. And so governments kind of in general are being very active in taking cyclical roles, especially when equity markets have been kind of collapsing in the recent past. This relates to the result that I was telling you about, that kind of different types of jumps have different implications for follow-on financial market behavior. So in particular here, we're comparing what happens to real volatility, real financial market volatility in the days after different sorts of jumps. So in kind of yellow or orange here, we see the volatility after monetary policy jumps. The red is looking at all other types of large market movements. So after all of these days, you know, there is kind of more volatility, but there's substantially less lower levels of increases of volatility after monetary policy jumps. So basically, these monetary policy jumps seem fundamentally different, that you know, they're kind of resolving uncertainty, whereas a lot of the other sorts of large market movements are driven by news that increase uncertainty, and that uncertainty is kind of persistent over time. Okay. All right. The last thing that I want to talk about is kind of going beyond the categories and thinking about some of the clarity of the explanations. So we actually have 4 different measures of kind of how clear these jumps were, or how clear it was that a particular cause drove the financial market movement. And we're going to have 4 different metrics. One of them is going to be the pairwise agreement across coders. So if our coders were reading different newspapers and the articles were somewhat confusing and they disagree a lot, and the journalists disagreed a lot across papers, that would be reflected in a low pairwise agreement rate. We also have 2 things that are just subjective measures of the ease of coding the article, or the ease of categorization, and then the journalist confidence here, okay, or here. So this is basically, you know, did the journalist come out in the first sentence or in the title or the first paragraph say, the markets moved yesterday because X? Or did they kind of just discuss what was going on and kind of meander around for the whole article? And then the last thing is the share of coders that coded the cause as unknown. All right. So sometimes journalists are very open and forthright, and they say that, you know, nobody knows why financial markets moved yesterday. You know, we talked to a lot of traders, and none of them could tell. Okay. And just a couple examples. So these are actually the highest and lowest clarity days in kind of the recent past in the US. So the lowest clarity day was in 2000, and you can see that this is looking at intraday movements, and there were just the whole day was extremely volatile. It ended up about 3.2% up, but nobody was quite sure why, right? Markets were swinging all day, everything was super volatile, but there wasn't one clear cause. The highest clarity day was about the same time a year later, when, you know, markets were relatively flat. The Fed made an announcement, markets shoot up, and then they're flat for the rest of the day, okay? And so, you know, there was one clear cause. There was a Fed announcement at 10 a.m., and, you know, that's obviously what drove the market. And so everybody knew that. The journalists were very clear. The articles were very clear. The coders coded it all in the same way, and newspapers kind of agreed, and nobody coded it as unknown. And just like we saw lower levels of volatility for monetary policy jumps, we see much lower levels of volatility following high clarity jumps. And this again goes to the fact that, you know, some of this volatility tends to be persistent. This uncertainty tends to be persistent. And after days where the market's been, fluctuating around and nobody's quite sure why, that kind of bleeds into the next days and weeks as well. Okay. All right. The very last thing I wanted to mention was, this geographic source. And so this is just looking at the fraction of jumps across countries outside of the US and Europe that attribute jumps to the US or to events in Europe, okay? And so there need not be a jump in the US or Europe, but this is basically looking at, a large financial market movement in Australia and looking at the fraction of times Australian jumps were coded as being caused by news emanating from the US or emanating from somewhere in Europe. And you basically see that, Europe here has a higher GDP share than the US in terms of the overall economic weight in the world economy, but very few financial market jumps in other countries are being driven by news coming out of Europe, whereas it's very common for lots of news out of the US to be driving financial market movements in other countries. There's a couple small deviations from this. So this is basically the European debt crisis, where you get actually a number of other countries being driven by news coming out of Greece and Italy and Germany and things like that. And this is kind of, there were some things related to the EU, but the bigger thing was the fall of the Berlin Wall, the dissolution of the USSR, and kind of events in Europe around 90, 91. All right. And so we have a different website for some of this data. So if you go to stock market jumps, we have all the Wall Street Journal data up there for the US, and we'll be posting other data as well. So if you're interested in using it in any way, feel free. We have lots more data. We just haven't updated it yet. But if there's something in particular you'd like to see, just let us know, and we can try to kind of prioritize that to the extent that we can. All right. So we look forward to seeing what creative uses other folks have for this sort of data. Okay, so we're almost out of time. Let me just sum up and say that I think Nick and Steve and I have gotten a lot of mileage and had a lot of fun and kind of investigating uncertainty with newspapers and with textual data in general, and trying to build out extract economic content from text. We think that uncertainty is a big topic. A lot of it seems to be from policy-related sources by a number of different metrics, and this policy-related kind of component seems to be, if anything, growing in importance across a lot of different countries over the past couple of decades. We think that measuring uncertainty has been difficult, has been often linked to financial market uncertainty, but we think that there's lots of other dimensions of uncertainty that can be now analyzed much more easily with lots and lots of sources of digitized text all over the world. We think that kind of automated approaches have had a lot of pros, fast to produce. There could be long time series, can be very flexible. We think that humans still have a place, that there's a reason we go to school and learn economics, and we can put some of that learning and education to use in interpreting text. It's a lot more flexible. It can be a lot more context rich, but it can be very expensive and slow, and that's partly why this second paper has taken like 9 years now since we first started it. But hopefully the payoff is worth it, but we'll see. So, happy to stick around and chat if anybody has any questions. Otherwise, thanks a lot for having me out.
Yeah, thanks a lot, Scott, for your very, very fascinating and very cutting-edge method for the second paper. I mean, it's very, very interesting to see like these angle kinds of news drive the stock jumps. So I just want to ask whether any participant today want to have any questions. I just want to highlight this is like the most crowded, the most crowded event that we have participants until now. Okay, so any participant have questions, please go ahead.
Hey Scott, I have a quick question.
Yeah.
So from a conceptual standpoint, we know that risk and uncertainty are kind of different, right? There's a line of economic research starting with 1921 that says that uncertainty is when you can't determine the probability distribution of future events happening. Whereas for risk, you can sort of, determine or estimate that probability distribution. And so the implication is that for uncertainty, people like in firms as well, like economic agents in general, they would prefer to wait and see because they don't know what's coming. Whereas for risk, they can have mitigating actions. So, but it looks like from an empirical standpoint, it's kind of hard to, capture these two concepts separately. So can you maybe talk a little bit about how you measure may actually capture risk as well?
Yeah, I mean, I completely agree. I mean, I think that, we've stayed fairly kind of neutral in this discussion. That I think that our index, and a lot of the indexes kind of that take a similar approach, are picking up a mix of hedgeable things and kind of knowable things versus very unknown unknowns. I think that we, in a lot of these metrics and some of the policy related metrics are tilting a bit more towards risk because, we do see a lot of spikes around, events where they are, there's prediction markets about elections and we kind of understand, a little bit about, what's going to happen. And we know maybe the probabilities of the various parties winning. There's obviously lots of uncertainty around those predictions. And then there's also uncertainty that can be hedged more or less explicitly. So if we're worried about, the price of certain types of commodities going up, and we pick that up in one of our metrics, some of that can be, there's lots of futures contracts where you can kind of hedge that and get a market price for that sort of risk. So I think that our index isn't as well, or as it exists, isn't as well suited for kind of parsing those two different things. There are a couple people who are trying to build richer kind of natural language processing models to try to incorporate some of that variation where, articles or firm releases or earnings reports kind of delve a bit more into detail into firm exposures to different sorts of risk. And there they try to kind of quantify levels of clarity of the of the distribution space, basically. Mm-hmm. So yeah, I think our metric is, we've kind of had these people who are devout Knightians or devout others who since we started working on this, and we've kind of sidestepped the issue a little bit just because our metric maybe wasn't sophisticated enough to think about it. But I think it does play into if you're plugging these into different sorts of theoretical models, then you have to think a bit more carefully about what exactly we're capturing in that element.
Okay. I mean, based on the empirical findings, a lot of the studies show that firms tend to wait and see, right? They reduce their employment, reduce M&A activities, reduce investment activities. So I guess to a certain extent, you can say that your measure is about uncertainty because it captures more of that wait and see strategy rather than some sort of hedging activities, right? As people
yeah, I mean, I think some of it is, so there's lots of cool papers that have tried to look across, firms with different levels of fixed costs of investment or things like that. And so, some of it I think is that it's uncertainty, but I think some of it is that some of these actions are not so hedgeable, or the cost of hedging is too high relative to the cost of wait and see. So I might have a precise knowledge of how likely something is, but it still might not be worthwhile. If there's going to be a tax credit or not for a different type of car, and I'm going to build factory A or factory B, I might know exactly what's going to happen, but the fixed cost of building the factory is non-recoverable, and so I might as well just wait and see. So I do think there's some bleed over between those two, between those two kind of concepts in reality. But yeah.
Okay. Well, thank you.
Absolutely.
Please go ahead. Yeah, please, Lynn.
Hi, Scott.
Hey, Lynn.
Thank you for such an amazing talk. And I must say that I have been following your work for a while, and I really admire what you and the co-authors did. I was very interested in the second paper that you present that looked at stock market jump. And I think that it might be interesting to also extend this to look at, say, oil energy market jumps. So it would be great if we could chat sometime like after the talk, so that I can get some feedback or ideas from you.
Yeah, sure. Yeah, shoot me an email.
Yeah, perfect.
Yeah.
Thanks.
Yeah, thanks. Yeah, Keith, please.
Hello, Professor. Thank you very much for a very interesting presentations. I have looked for your index for a while, about 3 years ago, when I preparing my PhD proposal, and yet right now I'm continuing to work on it. I figure out about the index of work uncertainty pandemic. So when I look deeply to the index in the measurements, I found that you concerns the total count of mentions of epidemics that you normalize for total number of words.
Yeah.
And in that case, you have covered all of the pandemic across the time and rolling over. However, I concerns that because recently I look at some paper that they focus on the search model, which is sustainable, infected, recover, and death. So based on that kind of model, they define 6 level of lockdown. So what I want to say is that can we kind of interact between the lockdown treatment to different kind of pandemic? I see it's really potential because for different country and different reasons, like Toàn have just several paper about Vietnam. He already how can I say, look deeply to the sensitive change for different kind of treatment for the lockdown. So I believe that if we can, how can I say, construct some inclusive index that check the volatilities for different lockdown and different level of treatment from different governments, maybe the volatilities might be more significant. I think so.
Yeah. I mean, I think that there are some kind of empirical measures of like lockdown severity, but you could definitely try to kind of incorporate some of those concepts into the like infectious disease sort of tracker as well. That discuss how much discussion is there about various elements of the lockdown, and there might be some kind of nice components there. Or I mean, one downside with some of these lockdown metrics is that they're very kind of all or nothing. That often they're very stark different levels. There's 4 different levels or something like that. Whereas if you think that newspaper-based discussions of lockdowns is going to be kind of a more continuous and maybe more informative measure that could be extended across lots of places, then that could definitely be something to try to check out. And that's a nice thing, is that you can kind of feel free to experiment a bit, as long as you can write up some pretty simple code to scrape these things.
Yeah. Because I see in your index at the first quarter in the year 2020 is high, raised to the quarter 3 and then decrease again. So I read in some paper that in the first time of the COVID, people have reacted very seriously, and they if they need chance, they feel more worse. But in the end of the day, when people already familiar with that kind of pandemic, so maybe the impact is maybe not.
Yeah, I think there was some, and there was also some kind of decline in people in kind of compliance with some of the lockdowns, right? That even though like the statutory laws might be the same, maybe people stopped complying. And so, potentially discussions in newspapers or other textual sources, or, Twitter, or, whatever else, might be a more nuanced kind of approach, that, the law didn't change, but people's behavior did. And so, or maybe they're just, topics of discussion changed. So I think that's one of the nice things about, textual measures, is they can potentially reflect reality a bit more cleanly.
Yeah, thank you.
Thanks.
Sorry, can I to the conversation a little bit?
Sure.
Okay, so I've been doing infectious disease for some time, especially during the COVID-19 pandemic. And what I currently see is that the situation in Vietnam is a little bit complicated because sometimes the text does not fully reflect what is the situation going on. So for example, if you have different you have different measures of lockdown, right? But if you apply the same measure in 2020, it's totally different in 2021 because the way that the people react to the lockdown, react to the pandemic, when there's vaccine or not, when there's different conditions that's going on or not, and the whole world situation is also different. So in this case, text mining is not actually the best case. What we have been working on is we use a measure to quantize the behavior of people, which is the Google Mobility Index, and which is actually pretty useful in understanding how are people actually reacting to the measures in their everyday activity.
Yeah. No, I think the mobility data is absolutely great. Yeah, that's probably why.
Tháng 6 đây rồi, hôm trước chị xem của em, qua chị xem rồi chị thấy tốt mà. Bây giờ chị đang nhặt ra công việc cho từng.
Thanks. But yeah, so I mean, I totally agree. I think that, text, especially something like newspaper reports, isn't always going to be the best approach. I think, something like Twitter might be better to kind of reflect what people are actually doing, kind of similar to the mobility data, or whatever. So I'm not sure what the primary, Twitter-like service is in Vietnam. I don't know if it's Weibo or whatever else, but yeah, so that might be kind of more reflective that, if people are talking about restaurants on Twitter in the US, I would expect that would kind of correlate better with like US mobility versus newspaper articles. But you can but yeah, I mean, text is not the thing to solve all problems, but I think that you can be pretty flexible with it. So
yeah, thanks. So Ruwek, I saw that like you raised your hands at the very beginning, so please go ahead. Ruwek, I mean.
Okay. Thank you so much. And okay, thank you so much. And I just have a question about the regarding just the economic policy uncertainty. And I just have a question just that. Well, just we show that many people study about many researchers studied about the gems and just the in the future markets, and also they use the mathematical tools such as stochastic models. So Professor Baker, and did you ever just compare maybe just the accuracy in between the theoretical models and just the EPU? And so because just that and in the investment field, and just if we want to employ just the EPU as a button just for the investment, so we maybe just have some requirement just for the accuracy or something like that. Thank you.
Sure. So I'm not sure I got the full question. I mean, but I think in general, we have compared it to things like options prices or implied volatility. I know a number of traders and kind of hedge funds do use the data. So I think that there's predictive power that kind of bleeds into firm specific implied volatility metrics. I think that this is one component. So there's lots of other things that drive. You're looking at like firm volatility or market volatility, or models of such. There's lots of things that drive that drive those parameters other than kind of policy uncertainty. And so we think that we're capturing kind of one element of uncertainty and an important element, but not kind of everything. So certainly correlated with a lot of these, with these financial market products that kind of track volatility and uncertainty, but it's not a perfect correlation, certainly. I don't know if that sorry, I wasn't quite sure if that answered the question.
Okay, thank you so much. And thank you so much.
Yeah, thanks. So Levan, sorry, please go ahead.
Good morning, Professor Baker and dear participants. Yeah, good morning. Thank you so much for your valuable sharing this morning. And following, allow me to introduce my 2 new papers on the application of daily time series data. Please, yes, allow me. The first one, this is my new paper. It's about the Twitter daily happiness sentiment. It's about happiness and wealth global. In this paper, I have found that the happiness increase the wealth of people, and the wealth mitigates the wealth volatility. Yes, allow me to share. This is the first one. And the second idea is about the relationship between the stock index and the air quality index in Vietnam. Yes, thank you.
Thanks, Levon.
Thanks a lot. So, Trí, go ahead.
Hi, Professor Baker. Please me introduce myself. My name is Trí, a PhD student from University of Economics, Ho Chi Minh City. So I listened to your awesome presentation, and I have some questions for you. First is because my mom is a professor in computer science, and she worked in natural language processing. So she's talked some of her research about how to decompose the news online, and how
I'm sure she'd be very unimpressed with our approaches.
No, she's on a different field. So so that's, but English and Vietnamese has the different grammar structures, and also different variations in norm and stuff. So they if you can and I see is at one time, and she talked to me that there are some different methodologies that can just destructure the sentiments of the consumers, and maybe it's some correlation to the investors in some ways. But how do you look into the ways that computer science do, and and also apply it to your research? And the second one is I want to ask is your methodology, your methods mainly work in the EU and US, where there are some freedom of expression, but if they are in the countries that the government still has some controls on the media and news, and I mean the new newspaper, they may belong to the government, and there are some, because I read some newspaper in China, and there are some news, very interesting news, and they just deleted immediately 5 minutes after they post. And some other thing is like there's some main ways, like other than the newspaper, like in the US they use the Twitter, but not the Twitter is not very popular here in Vietnam. So they may use Facebook, and the Facebook data is quite a mess. And how you try to manipulate the data and get the some kind of reduce the noise in the data.
Yeah, so let me start from the end. So we've never worked with Facebook data. I think it's probably harder to get. The Twitter is pretty accessible via like an API, and so they make it relatively easy to scrape. They have some volume limits on it, but it's not too hard. So yeah, I've never tried to do it with Facebook. I would imagine that would be tough. I mean, some researchers in the past kind of have worked with Facebook to get various sentiment measures and things like that, but I think they've mostly been like actual employees or have other sorts of contractual arrangements with them. So I haven't tried that. And I think it potentially would be tough, but I think, depending on their different social media networks across different countries, and maybe some of them are very open to researchers, working with them, and maybe some are not. So I think that could be more hit or miss relative to newspapers. On the kind of government control of newspapers, yeah, absolutely, that's kind of a big problem. And in some countries where the longest standing newspaper has been controlled by the government for a long time, I mean, it makes it more difficult to utilize that. We've tried to stick to newspapers that are relatively kind of unconstrained, even in countries that have more authoritarian governments. but that has been one reason. Like, so for, China, our first China-based index was actually based on the South China Morning Post in Hong Kong, back when Hong Kong was a bit more independent. Yes. The SCMP didn't have so much oversight. But we thought that was kind of a more going to be a better view of the mainland than any of the mainland papers necessarily of kind of sensitive topics. So, we have some, Shanghai papers now, but I agree. I think that there are significant shortcomings of kind of relying on papers that have potentially a lot of censorship or government oversight in general, especially when we're focusing on news about government policy decisions. So I think that again is something that's hard to get around. In other countries, in some countries, maybe you could turn to things like Twitter or social media to get metrics of this, right. Which might be less constrained. But China, that would probably still be difficult, given the level of oversight there as well. Your last question, I think, was about using different kind of topic modeling approaches, or using different natural language processing.
Yeah, that's what actually was the first questions. Because
go ahead. You can restate it.
Because in the beginning of your presentations, and there was a slide that you say you use the Python as your primary coding language. So that's that kind of thing I'm kind of interested in, because like manual approach is according to you like very expensive. And harder to get people.
It's hard to hire a big team of RAs for 5 years when you're a student.
With a great understanding of economics and stuff. Right. So like there are any ways like can get some more participants that have lesser of understanding of the economic stuff, but kind of more like get the process quicker.
So I sorry, you're asking, if you could use the automated approaches. I think so. A lot of my stuff is actually done in Perl, because I'm a little bit older, and that was cool when I was in grad school. Python's cool now, so everyone, all my assistants and stuff, everyone I work with now uses Python. But I mean, there's tons of resources online. I mean, we use very off-the-shelf kind of scraping tools that in Perl, like www mechanize and similar packages in Python. So like we're most of the stuff that we do is very kind of like relatively simple, like as far as NLP stuff goes, or like your mom's certainly knows more complex things in like the CS world. But we kind of think that level of clarity and like there's no black boxes. It's very clear what we're measuring. And we think that has, some substantial appeal. There's other folks that, and we're kind of moving a little bit into a more complex direction, but other people have gone very far in that direction and are using very complex, tools kind of closer to the forefront of machine learning and NLP techniques to kind of accomplish similar goals. Often still with Python and kind of off the shelf stuff. I'm not like a fantastic programmer or anything, and I just am mostly, Google lots of answers.
Okay. Thanks a lot. Actually, I just have like 2 comments, 1 comment and 1 questions from my side. When I listened to the second paper regarding to stock Trump and stock jump, and I also think whether in the US you also have like 2 different perspectives. One is regarding to Democratic and one is Republic. I'm not sure how like the angle of them, maybe this angle not to converse, maybe they diverse, not converse. And I also read like working paper entitled like echo chamber. This means when one group is like stronger than the other groups, they also ride the Polish or the Paris stock market. So I saw that like you also did like journalist confidence, but did you like estimate whether like the tone of Republic or Democratic they dominated on the news, they might ride the stock jump as well.
Yeah. So was that Tony Cookson recent paper? Echo
Yeah,
chambers?
exactly. Yeah, echo
okay.
chamber,
Yeah,
exactly.
Yeah, that's an interesting paper. Yeah. So I mean, I think for the purposes of this like application, it's a bit less of a concern since we're just, we're talking about more discrete things. It's not like opinion pages. It's not, they're generally not talking about whether a policy is good or bad so much, because it's like it's in the context of an article that's about this large market movement kind of on the business page. And so we haven't split we can check like across different papers. Actually, no, we did check, and there wasn't a systematic huge difference in the categories, at least, that were attributed to. I'm not sure if we aggregate that to Republican and Democrat leaning, if anything would emerge, but in general, there wasn't. And I think that's just because, like the front page news or the opinion page news or the politics page news has a lot more of those slants. And I think the business page, where it's just talking about the article that's about yesterday's market movement, is kind of less political. So even if it's talking about a policy announcement, it's usually a bit more factual than opinionated. And so we think that it's not at least for this application, it's probably not a first order problem.
Yeah, that's true. But maybe, I'm not sure, because like, for example, like in Vietnam, like if the stock jump and the next day, I mean, all the news, they have like the same category. Yeah. But I supposedly like,
I mean, they could say it like in the US, you might say the government did this and stock markets fell, but that's okay because it was good. And another paper might say, it fell for the same reason, but it's bad. Okay. So I think, we're still trying to isolate the what happened versus like, do we like it or not because we're Republican or Democrat or left or right or whatever.
Okay. Yeah, thanks. And the last thing I just want to add something is I'm also like my co-author. So listen to the talk today. We have finished like collecting the data from all the Vietnamese newspapers since 2002 now. Then we are constructing like Vietnamese EPU based on Vietnamese languages.
Oh, so very cool.
We collected everything, and I hope that like one day when we finish and also have like the data, it might be like the names of Vietnam also appear on the policyuncertainty.com, right?
Yeah, absolutely. Yeah, shoot me an email. We'll get it set up. No problem.
Yeah. Okay. So I think we also have very good shot of time now. Even we have one question from Ging, right?
Can I have a question?
Yeah, please.
Yes. Yeah, thank you very much. I'm Lam Dang. Good morning, Professor Becker. Yeah, I'm just gonna have one question for you. I'm just a little bit concerned about the endogeneity of the Economist Policy Uncertainty Index. So the EPU constructed using newspaper, right? So my question is the first thing, the media, say in this case, the newspaper might bias in producing or disseminating news. Sometimes they use positive tone, or sometimes they use negative tone, even in one event, the first one. And even the media not biased, but the economic policies sometimes can be driven by other factors. For instance, it could be driven by political issue, or even firm might lobby economic policy, right? So just my question, how you arrest the issue in the economic uncertainty?
Absolutely, yeah. So I mean, some of it is through some of the validation that we do. That at least our measure is kind of picking up the articles that we think they're picking up. And so that was part of like this human audit. We also think that the methodology we can validate a little bit by taking the same methodology. So I show that if we take the same methodology and apply it to kind of financial market uncertainty, it matches very well with kind of empirical financial market volatility through realized or implied vol. And so we think that at least if journalists are not biased in that way for financial market news, maybe they won't be so much for this other sort of uncertainty. The other thing is that I mean, uncertainty is certainly correlated with other stuff and with first moment shocks, right? We think we're measuring, something that gives us some information about the second moment, and a particular type of second moment. But this is definitely correlated with the first moment. And so that's why, in our application in the 2016 paper, we try to control for the first moment, and time fixed effects and differential exposure to like policy first moments, and separately look at this differential exposure to policy second moments. And so I think that it's absolutely true, and that every paper that deals with uncertainty and measures of uncertainty has to deal with this sort of covariance between first and second moments of business cycles. And so that's definitely an important thing to keep in mind, that you shouldn't just throw in, EPU, that you have to think about kind of in what context are you using it, and what might be kind of varying contemporaneously with it. So that's definitely a good point, and one that I think people should keep in mind when using this index or other uncertainty indexes, of which there are many now.
All right, thank you.
Yeah, thanks a lot. So I think now we have very good chat, and it's also quite late now in the US. So last words, I would like to invite Professor Nguyễn. He's editor-in-chief of Journals of Asian Business and Economic Study. Is also like the person who hosts the talk today. He also says something to thank Scott. Yeah, please.
Okay, so good morning from Vietnam, everyone, especially Scott Parker. So through your presentation and through the discussion from participants, I think it's a very interesting story. And also we have found that we have a new trend for doing research in the future with the new approach of text-based measurement for uncertainty and maybe risk as well. Actually, so this morning we spent nearly 1.5 hours, and on behalf of Journal of Asian Business Economic Studies, I would like to thank Scott Parker and hope to see you in Vietnam in person. And we do hope in the next talk we will meet again all participants. Thank you very much.
Absolutely. My pleasure. Thanks so much for having me. Have a good morning, everyone.
Yeah, thanks. So I mean, actually, like when we have in person, we have also a photo shooting section. But actually now we also online. So the participant, if possible, please turn on your camera, and we also have like the photo shooting with Scott. That's it, like very interesting. That we also have like very great memories together, right? Okay. So one, please open your cameras. Yeah, 1, 2, 3, smile. Okay. Yeah, thanks a lot. I think it's also very nice to have all of you today. And I want to highlight that the next seminar talk will happen in the 8th June with the topic, regarding to finance. Also, we will welcome Nancy Su from Boston College with the topic risk aversion preparation evident from financial market and control experiments. So please reserve this day on 8th June. Thanks a lot. Thanks, Scott, again. Yeah,
absolutely.
Yeah, good night. Yeah, good night.
My pleasure.
Thanks, Scott.
Yeah.
Bye.
Yeah, bye.